Across Canada, we lost over 100,000 jobs this year. Start of the year, we were seeing inflation come down a little faster than expected. So I like to watch core inflation, but more specifically the 3-month annualized rate of core inflation, because it gives you a sense of like what's the underlying momentum. So if it's slower than like the 12-month, you can expect that inflation is going to start to come down. And what we were seeing in those 3-month core measures was inflation running at like 1%. Now that's why you have core inflation on a 12-month basis back to about 2%. So we had inflation that's coming down. We have a job market that's pretty weak. So not just in BC, where in total have lost jobs in 4 of the past 5 months, 60,000 private sector jobs. Across Canada, we've lost 80,000 jobs in February alone, over 100,000 jobs this year. So a really weak labor market, inflation that was decelerating. In my mind, that was a Bank of Canada that would, at the very least, be leaving rates unchanged and maybe would have to start thinking about lowering rates below. Like they're at the bottom end where they think is neutral for the economy right now, 2.25. Maybe they'd have to go to 2 or 1.75. Then, of course, the United States starts dropping bombs on Iran and the Strait of Hormuz closes and we have oil prices spike above $110. When we fed through like what the oil futures curve looked like after those events into our models, tells us, well, inflation's probably going to spike to above 3%. The impacts on GDP, so we're an oil exporting country, but this is a supply shock. So all it really does is increase prices. There's no new demand. So this isn't something where oil companies see like, oh, prices are rising, there's so much demand, let's invest more, let's hire more. There's a mild positive impact to growth, but that gets overwhelmed pretty quickly by the effect of everyone on this call going to the gas pumps. You get this sort of stagflationary effect where growth is a little bit lower than it would be otherwise and inflation's a lot higher. The real question then is, what does the Bank of Canada do in that scenario? There's a real bias towards fighting inflation in all macro models. So our little computer version of Tiff Macklem raises rates back to 2.75. In reality, I think it's a lot more nuanced. By most measures, this is the largest oil supply shock since the 70s. And then the other question then is it persistent? Is this going to last a long time? Like, can the Bank of Canada look through this? Doesn't seem to be ending anytime soon. From like oil experts I've read and listened to, like this is a pretty pivotal month for oil inventories. I guess a lot of production has been coming out of inventories, but those inventories are depleting rapidly. So we could see oil prices really jump if we don't get some resolution soon.